Alright, welcome everybody to CRInvestor and the Chasm. Where are we here? This is, let's pull up the sheet here so that you can all see where we are. Get rid of this sound studio. That was my first attempt at writing some theme music. So for all those who are regular watchers, you can see we're slowly making progress on building out this show. But welcome to CRInvestor and Chasm's Power Options Show for Monday, May 5th, 2014. It's now just after 5 o'clock Pacific time here. I have not heard from Joe, so we'll see how he's doing. Let's pop over to the TradingView community and see whether anyone here has said hello. No, we haven't heard anything from Joe. So, as I have explained, these are works in progress. This is basically my baby. I do have guests that come on periodically and that host these shows with me to talk about different option strategies and all those kind of fun things. Looks like I might be riding solo tonight, but that's just the way it goes. I happen to love the market. I eat, breathe, drink, sleep the market. So I'm at my post here on Monday to talk about options with anybody and everybody who's interested. We did have somebody earlier tonight that actually asked me to talk a bit about one of the option models. Let's see if he's around. You around? And if he decides to pop in, then we'll do sort of a one-on-one with him as sort of my tutorial in the lounge. For all those that are watching on YouTube, feel free to pop in the lounge as well. In fact, here I can give you guys the lounge address. Let's make sure I have the right page. There it is. So I'll throw that up on the YouTube link for you. Let's see what we got here. Boom, boom, boom. And then we'll put that over here. And that way, if you are part of the YouTube audience and you feel like coming and participating in the lounge, you're more than welcome. A cautionary word for all those that are listening: I am running this solo tonight. I have seen in the past that if you do run these shows solo, there is a chance that you might. Oh, so somebody's sending me messages over here. Let's see. I'm just going to say hello all. Please PM me for ADRs. Should probably spell for correctly, but anyway. You're more than welcome if you're watching on YouTube to pop into the lounge and be a part of the show. And as I said just a moment ago, unfortunately, because of the way these Google Hangouts are structured, if I'm the only person in the lounge and I'm running the show and I happen to disconnect, we may actually lose the call. So anybody who is watching on YouTube, heaven forbid, but it might just happen. If I do drop, I'm going to have to reinstate a new call. So one time, I think a week or two ago, that exact same scenario happened, and I had to basically do a part 2 of the show. So that's just the way it goes. No big deal. I just got to roll with the punches. Anyway, so this is the option show that I do on Monday. We talk all about everything about options. If you're not familiar with options, this is a great opportunity to learn how they work. I run 2 particular option strategies. One that enables me to play the bigger market, and we'll get into a couple trade ideas with regard to that in the commodity trend survey that I run. And I also run another options model that is all about writing options. And that's, as I explained to the gentleman earlier tonight when I was trying to explain the whole situation, that's sometimes a little bit harder for people to wrap their head around. Um, you know, if anything, just take it for what it's worth. But if you do want to take the time and effort and learn how options work and how the professionals use them, you know, this is the venue. I mean, basically, I'm here to help you guys. I was an options broker for a number of years. You know, maybe I ought to take a moment and just talk a little bit about myself. And I have to do my little sales pitch here too at the beginning, so let's get that out of the way as well. So first and foremost, I run a website called TheRationalInvestor.ca. We're actually slowly going to migrate this over to a .co website. And that's going to be a subscribe site. So my advice to you is, if you are watching this and you want to take advantage of as many free resources as possible, do it before this site goes down and the pay site goes up. So just a word of wise. At the moment, how do I get compensated for these shows? You know, very simply put, this is based on karma. If you happen to learn something, if you happen to get some good advice, if you happen to, well, we have to be careful about using the word advice, thanks to the regulators. If you happen, I'm just going to simply say, if you happen to get some ideas that resonate with you, and you've talked with your financial advisor and you reviewed how the appropriateness for any ideas with that advisor, and it works out in your benefit and you'd like to return the favor, you're more than welcome to go to the website, therationalinvestor.ca, and you can donate. I have a nice little Bitcoin donation fund. You can see quite a few people have made donations, so thank you very much for everybody out there in internet land. And what this has actually done is it's given me the opportunity to trade Bitcoins, which is a lot of fun. If you are interested specifically in Bitcoin and Bitcoin story, we do a show on Wednesdays with a popular TradingView character named Flibber, and we do the cryptocurrency show on Wednesday. As we said, this is all about options, so I'm going to be strictly speaking about what the broader trends in the markets are, how you can play them using options, and you know, what are some of the risk-reward ratios. And then we're going to talk a little bit about the WDB, which is my options algo, and how you can actually get paid by the market to take positions in stocks. Which, you know, frankly speaking, if anybody ever could figure out a way where you can actually get paid to buy stock, they might just reinvent the wheel. And that's basically what I think I've done here. So if you can take advantage of it, the interesting thing about that, and we'll get to it in a bit, is, again, you can go to thisrationalinvestor.ca, click on the CRI's algos. These are the algorithms that I run on the market, and you can click on the WDB model, which is a web service unto itself, and it's sort of in beta right now as I just sort of work through the various bugs and bring this up to production quality. And you can actually sign up for the reports free because it's still in beta version. So, you know, I would highly encourage you, if you can take advantage of that, to do so. I am hearing some messages coming through on the TradingView, so let's go see what's going on here. There's somebody who wants the YouTube link, so let's get them pointed in the right direction. And let's make sure that you guys are seeing everything correctly. Good, looks fine. So where were we? We need to go over here and give this gentleman this link. Boom. All right, that's done. And how about this person? Can I get a YouTube link? All right. Boom. There you go. And where are you, Mr.? Oh. Did he just come in? What happened here? Somebody sent me a message. Thanks. Well, you're welcome. All right. So what I usually do here, because what I found in internet land is Um, if I do a show from, say, 5 to 7 p.m., the first hour or so, people just slowly trickle in. And by the time the show ends, we have a full house. So because of that, I usually like to take the first half hour or so and just chit chat with people in the lounge and just get comfortable, get all set up. So we're feeling good about everything, and then get into the meat and potatoes of the show. If that means you fast forward to half an hour into the show, 5:30, so be it. That's fine by me. But what I've found is if I start jumping right into everything right away, I'll get people that'll come in 10, 20 minutes from now, and they'll be like, oh, can you say that again? Can you say that again? And it gets a little irritating. So that's sort of why I've decided to go this route. Let's see. I did hear somebody sent me a message. How to contact you. Here, I guess I'll go like that. Hi. All right. So we sent him a message. Mr. Fang Xiao. I don't know whether I'm pronouncing his name right or not. But he would like to participate as well. So I think just out of courtesy, because English might be tough for him, I'm going to pop in and just give him here's the YouTube ADR. Boom. There you go. All right. Okay. So I think we talked a little bit about the donations and all those kind of fun things. So now we'll just take a few minutes and talk a little bit about me. I brand myself as the Canadian Rational Investor. Now, who am I? My name's Brian Beamish. I was a full-service investment advisor here in Canada for more than 10 years. As my description attests to, I've worked in both sales and operations in various parts of the brokerage business here in Canada. I consider myself a student of the market. We're always learning. We're always adapting. The market is a fluid mechanism. Ironically enough, those that are drawn to the market usually are very sort of scientific thinking. And the irony of the stock market is that it is based purely on human emotions. So as a result, a lot of scientific sort of approaches, they end up getting punched in the nose in the stock market, and all the eggheads in the universities can't figure out why they can't beat the stock market. Well, the simple fact of the matter is that the stock market is a reflection of you and I as individuals, and we humans, we are driven by emotions. So as a result, emotion often dictates price action rather than logic. Having said that, there are ways to identify when humans are acting rather human-like. And me as a student of the market, that's really what I've concentrated on over the past 10, 20 years, is trying to identify when, number one, situations present themselves that represent the historically relatively consistent action. You know, they often say if you don't learn from history, you're doomed to repeat it, and I see that happen in the stock market time and time again. And then also, too, how can we take advantage of that sentiment? You know, when everybody's bullish, you should be bearish. When everyone's bearish, you should be bullish kind of idea. As a broker myself, I held licenses to broker stock deals, bonds, any kind of fixed income instrument, mutual funds. I was a commodities broker. I was a licensed commodities broker. And options on all of them. And the options, ironically enough, is probably the hardest designation to get because you have to have gone through and be licensed in all of the other stuff before you can even think about being an options broker. Unfortunately, when people think about options, the media itself has vilified the industry. And ironically enough, I would actually argue that the institutions themselves are more than happy to have the media lambaste options as super duper risky and just totally out of the question for Joe Six-Pack Investor, when they fully well know that there are ways in the options markets you can actually limit your risk appreciably and take just a fraction of the amount of risk that you would take on a bigger trade. But we can talk about that later. And then, like I said, I've sort of discovered this little anomaly in the market where you can actually have the market pay you to take positions in stocks, which I find absolutely incredible. And frankly, should I get to the point where I can put a trading stake together and attack the WDB in earnest, I think I'll probably just run that model for the rest of my life, because frankly, it pays you to play the market. I mean, most people, they have to pay money to buy stock, right? It's a net drain. This model actually pays you an income to participate. So try and figure that one out. Anyway, so I've worked in the business quite a few years. I have licenses to trade almost everything under the sun. I figured I sort of reached my professional peak when I was granted the designation Fellow of the Canadian Securities Institute, this FCSI designation in 2005. I mean, basically, there wasn't a heck of a lot more that I could have done in the industry other than being a broker. And the interesting thing about the brokerage business, like I said, I've done almost every single job in it. So because I've done all these different jobs, I understand how the business works. And the simple fact of the matter is, the stock market would not work if the majority of people didn't lose money most of the time. And most of the brokerage business is based on that premise, that this is sort of like a speculative endeavor. And if you dollar cost average, well, that's one way to play. But if you're thinking about options, really the brokerage community, all they want to do is take your money and flush you out. And really, I don't really like that side of the business. I mean, I've seen time and time again, you get some pretty nasty characters that are drawn to that. The Wolf of Wall Street is probably a great analogy of that. The term boiler room, these kind of things don't come out because people are really nice. They develop because greed, unfortunately, is a huge function of our society and humankind. And unfortunately, very, very greedy people are drawn to the stock market. I suppose you could argue me doing all of these video series is a testament unto itself about how sort of anti-greedy I am. I certainly am not charging any money for this information. And the most I ask for you is if you decide karma-wise that you'd like to reimburse me for the time and effort I'm putting in here, well then great. That's awesome. All right, so I left the brokerage business, because I really didn't like the stink of it, and I decided to basically go out on my own. I built various models over the years, and we'll get into a couple of the models tonight. How to actually participate in the market, and the models work very, very efficiently. I've also written a course that basically just sits on the internet. It's a free document. I'm more than happy to put it into the where are we here? Into the YouTube feed, just so you have it. It's about 70-80 pages long, but basically if you want an unbiased, completely straightforward manual on how to actually invest and become a good investor and treat this as a business as you should, I'd highly recommend you take advantage of that resource. Okay, where were we? I'll talk a little bit about me. So I put together a whole bunch of these free resources. These services that holds the bot and all the different models, they're all free to see as well. So I can put that link in the YouTube channel as well. So feel free to take advantage of those resources. They're there for you. Right, so that's sort of what I've said here. So I got my formal start in technical analysis, but I believe most of the valuable tools that I've learned over the years are based more on common sense than any magic wand trading approach or tool. I counsel people constantly not to fall in love with any one single indicator. That really, especially with technical analysis, it's a culmination of multiple signals that really give you the high probability setups. And the same thing with the fundamental screens that I do. We're not just going off of one piece of fundamental information. Usually it's a basket of fundamental information that sets up the trade. Having said all that, there are some really nifty little tools that I've learned over the years, and both technical and fundamental. And if you can learn from those handy little tools and sort of guidelines, it can make the process of investing a lot more fun and obviously a lot more rewarding. All right, so I bill myself as the Canadian rational investor. So what the heck is rational investing? You'll notice that there's two circles here in my logo. And you'll notice that the one's green, one's red. And you notice that the area that overlaps the two circles is in white. And that basically is the premise behind rational investing, in that, for this example here, we're just going to say the green camp is technicians. So what's a technician? A technician looks specifically at price action, right? Basically, the price action is a direct message of supply and demand. So if you have prices moving higher, then it implies that demand is outstripping supply. And conversely, if you have prices moving lower, it means that supply is outweighing demand. And that's basically what technical analysis is. You can create a whole bunch of indicators and stuff on, relative performance, but in essence, it's just a very simple way of looking at supply and demand in real time. And the red circle here, this is what's known as fundamental analysis. Now, what's fundamental analysis? Fundamental analysis is the concept that everything has relative value. With stocks in particular, a stock is nothing more than an earnings engine, right? A publicly traded company, basically in our capitalist society, the idea is that they're in business to make a profit. And they are a publicly traded company, which means they've gone to the public and sold a part of the company so that to generate more money, and ideally that portion that they've sold to the public will finance further ventures to make more money. So, from a strictly stock perspective, fundamental analysis usually is centered around things like the actual book value of a company. So if you added up all the assets of a company and marked them to market, that would give you a good idea of what the actual assets are worth. Getting back to the concept of stocks being earnings engines, obviously it would make sense to equate the price of a stock, and that price is multiplied by the shares outstanding to give you sort of a market capitalization of the stock, and then compare that to what they're actually earning in the marketplace. And that is what's called a PE ratio, or price to earnings ratio. Two very, very basic, simple examples of fundamental analysis, but in essence, it's looking at a company, in this case, we're talking stocks, looking at a company and trying to figure out what the fundamental value of that company is, or what the fundamental value of that earnings stream is. So the bottom line here is that those two camps, technicians and fundamentalists, they look at the market from very different perspectives. They're both sort of career paths in themselves. And historically, what's ended up happening is that the two camps have generally disagreed with each other as to the value of their services. Just because somebody comes up with a fundamental value for a stock, it doesn't mean the stock has to trade at that level. And quite often, a fundamentalist may have to sit a very long time to wait for the price of the asset to come down into sort of their fundamental valuation zone. Conversely, a technician, just looking at pure supply demand, may actually, just based on the fact that sellers are outweighing buyers, may actually completely disagree with the fundamentalist, where a fundamentalist says, well, this is a buy, this is value here, and the technician says, oh, sorry, I don't see that, I think this is a sell, simply because price is moving down. So what ended up happening historically is the two camps actually don't like each other very much. And it's really a function of hubris, really. Who's got the bigger ego? Who says they're right? Who says they're wrong? And really, from my perspective, I couldn't give a rat's ass who is perceived to be more right. That's not really a concern of mine. What I'm concerned as a rational analyst is I want to find the area where the two camps happen to agree, where both the technician and the fundamentalist are pointing in the same direction. It turns out that if you screen your ideas, your investment ideas, with a component from both camps, the statistical odds of success of your idea go way up. And really, I think it just makes common sense. And when we look at the WDB ratios later, you'll kind of get an idea why technical bottoms come in where they do, and why you happen to see the technicians get excited right around where the fundamentalists often get excited. Okay, so that sort of describes a little bit about me. It describes a little bit about my history and the tools that I've used over the years. We talked a little bit about the rational analysis and what it is. And by all means, you're more than welcome to go to the website and do all the digging you want. As I mentioned a moment ago, obviously the course that I wrote, Introduction to How Capital Markets Work and Building an Investment Plan, it obviously is going to touch on those sections that I talked about in depth. And indeed, the first part of this course is Creating the Tactician, where we sort of talk about all the backdrop of the markets and how capital moves and does it get destroyed or created, yada, yada, yada. Part 2 is Fundamentally Thinking. Part 3 is Technically Speaking. And Part 4 is Getting Personal, or putting together all of that into a plan and looking at risk. On Saturdays, another gentleman at the TradingView community and I put on a show called The Trading Plan Show, where we go into depth about trading psychology and building plans and all those kind of fun things. So that's not really the topic tonight. Tonight is supposed to be all about options. All right, so we have basically two parts of this presentation tonight. The first part, and it looks to me like Joe's probably going to be a no-show tonight, so if that is indeed the case, I'll take another boo over there, see if he's around. If that is indeed the case, then we might make this show a little bit earlier, finish a bit earlier. There was another gentleman that was going to pop into the lounge and ask me a few questions about options, so we'll see if he turns up. We'll just play it by ear. Okay, so as I highlight here in my this is my Google Drive, and it's just open to the public, this part of it. This is my services folder, the various services that I offer. These are projects that we're working on, the pay site I talked about. These are the various models that I run. The S&P 500 model is basically a simple investing plan for those not really looking to participate too heavily in the stock market. They just want to know when to be in and when to be out. It's given maybe about 5 or 6 trades over the past 5 or 6 years. It got you out of the stock market in 2007 and got you back in late 2009. And it's still actually in the market right now. So that model works beautifully, but it's very slow. The VCIM model is a model that was taught to me by an old VSC floor broker. Basically, it is the smart money way to invest in venture capital, and I've yet to ever see any stock that has met the VCIM criteria underperform. I mean, these stocks, it's just absolutely insane how these stocks perform. 10 baggers are actually quite normal for this thing. The bot day trading model, this is the model that I day trade crude oil with. I work with a proprietary trading firm out of Chicago, Top Step Trader. I traded crude today. Basically, this is the trading model that I use when I trade futures contracts. It's not nearly as simple and clean as the S&P 500. It is strictly technical analysis based, but nonetheless it works, and it's what got me funded. So, the old adage, right? If it ain't broke, don't fix it. Tonight, we're going to concentrate on these two models. We're going to start with my weekly commodity trend survey model. Basically, this is the way that I participate in major global economic trends. And then we're going to finish with just a quick little blurb on the WDB options model. And as I said, this is the model where you actually can get paid to play the stock market, which, as I said before, I mean, I worked in this business for 20 years. I never heard anything like this before. And it was actually taught to me by an engineering physics guy who sort of figured out how the market works, like the brokerage side of the market. And he's very good at using margin to maximum. I've sort of simplified a lot of his rules, and it's such a beautiful little model, and we'll go through a few of the stock ideas that it's had later on in the show. So let's start off with a weekly commodity trend survey. It's now about 20 to 6, so I've been talking for a couple minutes. I reckon it's about time to get into the meat and potatoes. If you hear me take little breaks, it usually means I'm grabbing a sip of water or something. I don't know where Andre went. Anyway, hopefully he'll turn up sometime. Okay, so specifically now we're going to talk about the weekly commodity trends options model. And what I need to see is just to make sure that you guys can see this. How do I do that? I don't know if I can do that. Okay, well, you guys are seeing full screen, so that's good. Good. All right. Okay, so we CRI's Weekly's Commodity Trends Survey, WCTS, that's what that stands for, options model. Basically, option strategies to participate in global commodity market trends. And feel free, I'm actually going to turn these into little videos for YouTube. So they'll be up probably within the next few weeks. But feel free, you can go to this web address. I posted the folder address. You can go through these at your heart's content and learn all you want. So what are we going to talk about? This is just a basic introduction. What is the Weekly Commodity Trend Service? How does it work? We're going to talk a little bit about the advantages of using long-term option strategies. We're going to talk about what a weekly commodity trend survey setup looks like. And then we'll probably finish off with just a simple how to participate. So, what is the weekly commodity trend survey and how does it work? WCTS stands for Weekly Commodity Trend Survey. I think you probably got that idea by now. The model itself trades 6 to 12-month option positions off of the survey's trend signals. Trades are only considered where the intrinsic value of the option, either a put or a call, at the anticipated target price will be at least twice the proposed purchase price. So that's probably a mouthful, and we'll just slowly go through that. The model specifically looks at 6 to 12-month option positions, and I'm a big fan of LEAPs. I don't know whether you've ever heard of LEAPs. LEAPS. They stand for, I think it's long-term equity participation security, something like that. But basically, they are January expiry. So if you play the stock market, my advice to you is only look at LEAPs if you're considering these weekly commodity trend survey trades. We did a recent write-up recommendation on cotton, and we'll get to that in a bit. But basically, the recommendation was to buy a December 2014 option. And that was at the end of April. So that basically is like 7 months. So that's very typical. We never, ever, ever want to get into the situation of buying short-term or short-life options. It's just not in your best interest. Everyone out there should know the last 30 days of an option's life, the value of the option itself, if there's any time value or volatility premium, that disappears very, very quickly. So ideally, we don't even want to be around an option in the last 30 days of its life. Now, second point. Trades are only considered where the intrinsic value of the option, either put or call, at the anticipated target price will be at least twice the proposed purchase price. So what does that mean? Keep in mind that options have a strike price. So, if we just, what's the easiest way for me to describe this for you? We'll go to the Chicago Board Options Exchange, just for illustration purposes, and we'll type in SPY. This is the S&P 500 Depository Receipt. It's the biggest trading vehicle in the world, and of course it has options. So you can see the last price for SPY today was 188.42. And if you look at all of these options, you'll notice that there's a number that runs down the middle. This number is what's known as the strike price. What is a strike price? The strike price is basically the level at which the option has intrinsic value, or where there is actual, like, substantial, what's the word I'm looking for? If you're buying a call option, which makes money when the market goes up, then the strike price that you have minus the current market price is the intrinsic value for the option. So, for example, this option that I've highlighted in particular is the 170 strike price. Remember, we said that the SPY is at 188.42. So, because this is a call option that we are looking at, the intrinsic value of the option is simply the current market price, 188.42, minus your strike price, 170. So in essence, this option has $18.42 of intrinsic value, 188.42 minus 170. And gee whiz, you look at the option in the marketplace, it's bid 1568, and it's offered at 2065, which happens to be right in between that $18.42. So someone's bidding cheap, seeing whether they can get it for a steal, and somebody's offering expensive, seeing if they can get it at a bit of a premium, get filled, sell it at a bit of a premium. Long and short of it here is, this is the number that we're most concerned with when we want to play the market. So as I said in the description, we're only going to consider a trade where the intrinsic value of the option at our target price, where we expect the market to go to ultimately, right? And in SPY, remember we said that the current intrinsic value of this 170 call is $18.42. We could only consider that purchase, buying that option, if the purchase price is half of what the intrinsic value at our target. So let's say, for example purposes, we had a target of 188.42 on this SPY. So boom, it hit our target. Woohoo! We bought the 170 call, and we were shooting for that $18 of intrinsic value. According to our rules, we cannot consider this purchase. This is obviously looking back in time. We couldn't even consider it unless we could have bought this option for half of this $18 or $9. All right? Now, as you'll see later on, that might be a bit hard to understand, but as you'll see later on, options do often trade at far less than half of what we figure that they should be worth if the price hits our target. So, just to review this then, we only consider trades where the intrinsic value of the option at the anticipated target price is at least twice our proposed purchase price. That limits a lot of our ideas. And I actually did a write-up on the weekend when I did my weekly commodity trend survey that I believe that there is a bond market rally going on right now. The problem is that when we look at the options prices compared to the amount of risk that we have to take on this setup, it just can't justify, i.e., the intrinsic value of any options that we look at if at this target price are not double what they currently are. They're actually quite a bit more than that. So as a result, and I even pointed out in this write-up, that because of the risk-reward on the trade, I couldn't justify taking the trade. Now, that doesn't necessarily mean that bond prices are not going to move up. It's important to always be cognizant of what's going on in the market, but what it does mean with regard to the weekly commodity trend survey options model is that we have to be very selective of the options that we're actually going to trade. All right, what is the model not? Whoops, where'd we go? What the CTS model is not. Since signals are generated off the weekly price charts, this is not a day trading strategy. This is a position strategy, where typical hold periods are anywhere from a few weeks to several months. All right? The primary objective of this strategy is to book doubles. Remember, our criteria when we're actually looking at buying an option is that we need to see that at our target price, we're going to double our money, right? It's going to be twice what the proposed purchase price is. So that's our ultimate objective, is we want to book doubles. And I guarantee you that if you run a portfolio for 5-10 years, and you year after year after year put up like 70% return, 80% return, 90% return, 110% return, 104% return, 90% return, those numbers start to add up over time. And there's nobody in the market that beats those kind of numbers. It just doesn't happen. So I'm not looking for the 10 baggers off of these. All I'm looking for is it realistic for us to double our money? In fact, that double level resonates quite a bit with a lot of the models that I use. And my simple strategy, and it was a great way as a broker to keep clients honest, is we simply say if the double levels hit, we're either going to do one of two things. We're going to sell half the position and in essence create a risk-free trade on the other half, because if you sell half of your position at double your purchase price, you get all your original capital back in your hands. The remaining position, in essence, your cost basis is zero. So, whatever happens to the option is fine. Sometimes they go off the board and, oh well, it's a scratch. Other times, the darn market can just keep going and going and going and going, and they turn into just monster home runs. That's one sort of way of looking at, one strategy to use. If you are limited in your budget and you can't buy more than one contract at a time, then really my attitude is you just sell the position at your double, you book your 100% gain on your money, and you just sit tight and pat yourself on the back for a trade well done. All right, moving right along. Slide number 4. What are some of the advantages of using long-term options? The biggest selling feature I find with options, and I got to take a sip of water here, so give me a second. All right. The biggest advantage I find personally from trading options is this idea of finite risk. And basically I said here, let's face it, investing is a risky proposition at best. Many will claim to have high accuracy, but interesting, it's not so much your accuracy as it is your plan, discipline that makes longevity as a trader. Excuse me. That is making sure your average winner is bigger than your average loser, and you limit your risk. That's a very hard concept for a lot of new people to the market to come to. The great part about buying options and trading the market through options is that you literally define your maximum risk on any one given trade idea by the purchase of the option itself. And that's very different than stock ownership, and it's very, very different than futures ownership. And let's think of worst case scenario. The worst case scenario is that basically the option that you bought expires worthless. So, you know, if you follow my, if you read my course, and let's pull up the course just to make sure everybody's got it. You'll know that I have two very specific rules for investing. And if you happen to follow rule number 2 and you don't risk more than 5% of your stake on any one single idea, then by definition, you have outlined exactly how much you can spend on an option, right? 5% of your portfolio. And you know by definition that you're not going to risk more than that 5%. It's impossible. Unlike a futures contract or a short stock position, you could allocate 5% of your portfolio to one of those strategies. But hey, let's face it, if the market locks limit against you and the exchange is halted trading, there is not a damn thing you can do. And you could literally get wiped out, even though you said, hey, I'm only risking 5% of my portfolio. There is a realistic possibility, especially with open futures contracts, that you can lose everything if the market locks limit against you. And sadly, I mean, we haven't really been in a lock limit market in probably 30 years, if not longer. And most new people to investing don't even know what a lock limit market is. And sadly, I think that the market is setting up a lot of people for some serious heartache in the not too distant future. Simply because markets move cyclically, right? Their behavior is cyclical. They will go through periods of low volatility. They will go through periods of high volatility. It's by nature, all of the different market types have to be visited as we move through these 35-year generational cycles. It's my personal belief that we're heading into a fear cycle peak, very much like 1980. Anybody out there watching remembers what the 1980 commodities markets were like. Lots of lock limit moves, and a lot of heartbreak. So, just by definition, if we just stick to option trades, we avoid that whole potential disaster situation. All right, that's a little bit on finite risk. Interestingly, options at the same time give you unlimited earnings potential. Because like we said, you know, using our S&P 500 example here, the S&P could go to 10,000 as long as this option is still alive. Whatever the current market price of the underlying subtracted from your strike price, well, hey, that's money to you. So let's say hypothetically the SPY goes to 200. Well, 200 minus 170, that's $30 of profit. That's approaching 20% gain. Let's say the S&P goes to 300 before this option's expiry. Well, 300 minus 170, it's 130. Now we're up in the 40% return. Let's say the SPY goes to 500 before this option expires. 500 minus 170. Now the option has an intrinsic value of $330. Now we're well over 200% return. So the point of the matter is as long as the option is alive, and the price is above our strike price and it just keeps moving that direction, our earnings potential is unlimited. So that's another great reason to consider options. All right, and then the last point that I would make, and I sort of touched on this a moment ago, is appropriate risk given your portfolio size. And you know, the simple fact of the matter is, I mean, let's say you're dealing with like $10,000. You know, according to CRI's rules of investing, or CRInvestor, or Congressional Investors' rules of investing, we really don't want to be putting more than 5% of our $10,000 at risk in any one single trading idea. That means, by definition, really, we don't want to be taking more than $500 risk on any one trade. You could go slap on a futures contract, but hey, market could move more than that 5% in a heartbeat, and boom, you're gone. The options, keep in mind too, you know, like in crude oil, for example, if I wanted to actually buy the futures contract, it's 1,000 barrels of crude oil at $100 some odd a barrel. So that's basically that. The contract itself has a face value of about $100 some odd thousand. So it's completely unrealistic for me to even consider going and wanting to buy an outright futures contract. I haven't got $100,000. I've only got $10,000. So if you only have $10,000 and you only have, really, what we're saying with $10,000 is you only have $500 to risk, you can now, because you know the specific amount of money that you have to risk, you can actually go shop the long-term options markets just specifically with that rule number 2 in mind. And of course, like we said, because there's unlimited earnings potential, doesn't mean that just because you put $500 in, the option can't go to $10,000, $20,000. And we'll show you an example later on of a perfectly realistic target where our expected value for the option, if it should hit our target, is 300 times the purchase price. That's a hell of a trade, eh? Anyway, so advantages of using options. Number 1, it lets us define our risk, our finite risk. Number 2, unlimited earnings potential, even though we're only risking a very specific amount of money. And then number 3, because options are relatively cheap, they actually can work in your favor with sticking with risk asset allocation, risk per trade, and overall portfolio risk. So it's kind of like a win-win-win all around. And keep in mind too, just because you're nearing expiry doesn't mean that you have to ride the option into expiry. You could always just go out into the marketplace, like this example. This May option, they're going to expire pretty soon. So you could just go and sell that option that you're long and then just go and roll that exact same amount of money out into the June contract. Or you want to buy more time, roll it into, you know, I just listed the near-term options. But, you know, as I said earlier, I'm a big fan of leaps. You know, you could, as the options approaching, as the options expiry is approaching, you could roll out into, here's December 2015. Here's January 2016. So there's lots and lots and lots of options available for option holders. You don't necessarily have to just ride it into expiry. Okay, so I think we covered that slide pretty well. Next slide. All right, so the weekly commodity trend survey, how does it sort of work? And those people that go to the website or subscribe to the Twitter feed, you get notices that the weekly commodity trend survey has been updated. And all you have to do is click on the link, and it takes you basically, every week I do a survey of commodities prices, trends, targets, everything, all in one sheet right here. In fact, you could argue that this one sheet of paper here is probably like a $1,000 a year subscription. It's just I haven't marketed it. But this is absolutely invaluable information. So along with a simple commentary of what I sort of see going on in the market, I detail the trends of the current markets, what realistic targets are, how old the trends are, when they actually started, direction of trend, and by all means, at any time, you can click on any one of these charts to pull it up. So you see on the weekly commodity trend survey, the US dollar index, my impression is that the trend is down. The trend started on September 20th, 2013. It's 33 weeks old. The position is short from 80.87. Your stop now, interestingly enough, is at 80.77. And the target is 78.68.5, and that's just simply a bare ABCD harmonic pattern. If we look at the chart itself, you can see here's the breakdown in September. Here's the massive harmonic pattern, and you can see we've slowly made lower highs and lower lows. Basically, my target is down somewhere down in this area down here, and it's just slowly working its way down to the target. I cover currencies, interest rates, stock markets, metals markets, energies markets, softs markets, the grain markets, and the meat markets. And basically, this is sort of the world of commodities trading. Like I said, I was a licensed commodities broker. I used to execute these trades for clients all the time. So, I mean, I've done this for years and years and years and years. Where were we? Boosh. All right, so, you know, like we looked at the US dollar just and we saw that trend. So what do the trends look like? When I say a market's trending, what I'm usually looking for are M's or W's. So if we see either of these situations, M's or W's, then that is basically a trend direction signal. And as you can see, I mean, every single one of these markets does it, up or down, up or down. You'll notice that, you know, the trends in the stock market are very old. Look at these trends started back in 2012. So literally, based on these simple models, this stock market, and you know, if we look at the S&P 500, it shouldn't come as a big surprise to anybody. Where are we here? Let's go new chart. And it's pulling up my favorite market right now. We'll get to that in a bit. All right, so the weekly commodity trend survey, like I said, all it's doing is looking for higher highs and higher lows. What it wants to find is this is bullish action and this is bearish action, right? So we can see clearly the bearish action through here, right? And so this is back end of 2007, the market told you to get out. And 2008. In fact, look at that. It's December 2007, right? And then conversely, do we have WE type pattern here? You can see that we have, you know, this is a very wide one, but nonetheless, higher lows and higher highs. We got another one here, higher lows and higher highs. We got another one here, higher lows and higher highs. Another one here, higher lows and higher highs, etc., etc. And so if you approach the market, you see we got a little bit of a breakdown here. But you can understand, just based on the higher lows and higher highs, why the weekly commodity trend survey got all excited about these stock indexes right in here, higher lows and higher highs. As I said on the weekly commodity trend survey, these trends are now getting very, very old. And what I find really interesting is that the market that led us out of the bottom, the Japanese stock market, it's actually starting to break down. Hopefully you guys can see lower highs and lower lows. So clearly there's a disconnect going on here. Anyway, back to the presentation material. These are our signals, our trend signals, double tops, double bottoms. Our technical tool for coming up with price targets is what's known as the 50% rule. I sometimes use harmonic patterns. You'll notice that on my recommendations I have bull ABCD, bear ABCD. We can get into those at a later date, but simply put, the 50% rule is probably the easiest tool to use to get you going. And it just simply says, you know, a bullish scenario, the price used to be at, in this example, $10, and it came screaming all the way down to $2. We know that the 50% rule, and this was developed by a gentleman by the name of William Gann, he simply said you take that high and you add it together with the low and divide by 2, and it will give you a natural 50% retracement level. And this happens time and time again in the market. Very, very common. In fact, the first person that I learned to trade commodities with, Ken Roberts, this was his model. He just traded double bottoms, double tops, and 50% rules as his targets. So the bottom of this page here is just a nice working example. This is the US dollar index. You can see the double bottom-ish type pattern with these sort of squiggly lines here. In essence, higher lows and higher highs. And here's the 50% rule, and boom, you can see after the double bottom, the market slowly worked up to the 50% level. That's the chart on the left. Chart on the right, exact opposite. You can see, very similar to this pattern, we made lower highs and lower lows. There's your M, and boom, market goes to the 50% rule. Now, I'm not saying that the market can't keep going. But what I am saying is, for the purposes of the weekly commodity trend survey, if we found an option right when this M top came in, where the option premium is half of what the intrinsic value of the option would be worth at the 50% level, then that's a trade I'm very interested in taking. And so here's a great example where if you could have done 2 contracts, sold one of them at double your purchase price, and let the other ride, you can see that that runner or the free contract would have made you just a piss pot full of money. So very, very simple method of looking at the market, very effective. And if we stick to our very strict option purchasing rules, the odds of success are very high. So what am I going to do? You know, I'll just finish this slide presentation off. The end of this is how do we participate. I am thinking about offering basically a $10 a month subscription or $100 a year for this information. And you'll get basically an email report with a market commentary exactly. The irony of it all is I'm just giving this away for free now, and people are saying I'm just an idiot for giving this stuff away for free. So this is basically what I'm considering doing. In that service, you get a position review, all the entries, stops, AOC exits, excuse me, trade price alerts, any recent action taken, or levels to watch. So that basically is in a nutshell how the weekly commodity trend survey works. Now let's give you a couple examples. And keep in mind too, like I said, you can find these documents on the shared folder. They're just sitting there. You're more than welcome to look at them at your leisure. All right. Let's go find... I think what I'll do for the time being is we'll just load. Well, man, I spent a lot of time on this. So I'm just going to give you a current one that we're working on. And we'll leave it at that for now. So right now, I'm super duper excited about the cotton market of all markets. Cotton. Why cotton? I don't understand how that works. Oh, are these guys still? You were in. People in this hangout. Wow, there's 33 people in that hangout. I see. So that's where all you guys are. Isn't that funny? What am I going to do here? Let's go like this. Then we'll go like this. Then we'll pop over here. I was wondering where all these guys are, and they're all over there. And we'll go like this, like this, like that. All right, we'll see if those clowns come over now. All right. The chart that you're looking at right now came to my attention when I did my weekly commodity trend survey, and I noticed that cotton was breaking out. The breakout here is 93.90 and the stop 73.79. Now each point here in cotton is $5. So there's no way I could even consider a futures contract. That's 20 cents at $5 a point. I mean, we're talking some serious money there, right? That's $10,000. How on earth are we going to play this market? And the simple answer is, first and foremost, you can see how high she was. This market was over 225 back in 2011. Came screaming down, put in a very wide double bottom, which is basically held in here. So you remember our basic tenet from the model, we really want to find W-type price action. And so what I see here is we went down, then up, then down, then squiggled, then up, right? Then down, then squiggle, then up. So we're constantly making higher highs and higher lows. Now this low here broke this structure, but then you'll notice we quickly turned around and broke out through the top there. So lots of sort of WE type price action. This vertical line here is that date when that trade came up on the weekly commodity trend survey. And just out of curiosity, I said, all right, well, let's go shop the options market. According to Mr. Gann, 50% retracement of this monster move should take us back to about 145.96. It turns out that I could have bought a December, this should actually read December, 95 call option for 105 points. And as I said before, each point is $5. So the total cost for this trade is, this should be 525. $525. Actually, let's make that a little bigger. Boom. Believe it or not, and I think this is perfectly realistic, I believe this option, its intrinsic value at the target price, and I'm going to be conservative here. I'm only going to suggest that we get a rally back to the 38.2 fib. I'm not even going to say we're going to do a 50% retracement. If we do a 50% retracement, the numbers get even crazier. But at the 38.2, 127.11, this option will have 3,200 points of intrinsic value. And that's simply 127 minus 95. Very, very simple math. Right? At $5 a point, at 127, this option should have intrinsic value of $15,000. Remember, we bought this option for $525. 525 to 15,000. That is a big move. Now, what I find really interesting is that as time is going by, it appears to me that the street is starting to consider that, hey, this breakout here in cotton might be for real. Because, lo and behold, you'll notice there's the December 14. We'll punch up the call options. That 95-cent call now is trading at $1.44. So it's already moved up 39 cents from our purchase price. And this trade, in my opinion, I don't even think the trade has really gotten going yet. Where did it go? You know, I mean, all we've done, and what's really fascinating is that the breakout came here. Price is basically the same level. I mean, it really hasn't moved a hell of a lot, and yet the option's already moved up 30%. So for us to realize a double on this trade, I think is perfectly realistic. Now remember, if this option is bid $2.10, out goes half right away. Boom. Get your original money back in your hands. And then you're playing on a free contract, and my hunch is that there could be a lot of money to be made on this trade. So this is a very typical weekly commodity trend survey trade. Oh, by the way, if the market happens to go to the OTE short sweet spot, and this is where institutions will be shorting, this option will have an intrinsic value of $40,000. 500 into 40,000. That's ridiculous. Now, the question really is, you know, do I expect that to happen? No. But is this a realistic risk? Is this a good place for us to be considering putting $500 to work? And I think the answer is an emphatic yes. All right. So it's now about 6:30 here. Man, I can't believe how much I talk. I was going to get into the WDB, but my feeling is that, frankly, I can't believe I've talked for an hour and a half. That's remarkable. I think I've exhausted myself. And actually, I was expecting a whole bunch of these guys to turn up because they had a whole bunch of questions about this seminar, and they just haven't arrived. So no big deal. I guess I got to feel kind of fortunate that we were able to get through this without having the Google Hangout drop. So I'm happy about that. Since we don't have anybody in the lounge, it's awfully tough for me to open the floor up to questions. So, I'll pop over to the YouTube page. I'm on the YouTube page now. I do see we have a few viewers. So by all means, if you do have questions, feel free to type them in there. And I'll be more than happy to try and address anything that we've talked about. So I think what we'll do is we'll save WDB for next week, which will give you guys lots of incentive to tune in next week's show. And we'll just summarize, you know, sort of what I see happening in the broader world through the weekly commodity trend survey. So, you know, what do I see? I see the U.S. dollar slowly working its way down, and really that's exactly what should happen during these cycles. Canadian dollar and Australian dollar are a little bit weak, and so if we look at the Canadian dollar, keep in mind that the Canadian dollar is basically a proxy on commodity demand. So the fact that the Canadian dollar is weak actually tells me that the world economy is still on the mend. We don't have a lot of expansion here in North America, not a lot of commodity demand in North America. I look at the Australian dollar, I see, you know, somewhat the same thing. The market tried to bottom here and then broke that. I don't believe we've put in a really clean bottom here. I think these lows need to be tested again. So I'm not really too excited about that. And as you see, you know, We were short on the Canadian dollar. Stop was hit. We're still short on the Aussie dollar. So that's still working. I find it really interesting what's going on in Europe. I do believe that they're slowly turning the corner on their financial crisis. And you can see that the currency is appreciating. Basically, we've had the euro moving up now for 72 weeks. And again, that's basically what should happen during these cycles. I think Germany got a major windfall gain by having the euro artificially weak because of the southern European nations. And I think Germany actually kind of took advantage of everybody else there. And you can see that by the amount of BMWs and Porsches and all the German Mercedes-Benz. I mean, God, they're basically taking over the auto industry here in British Columbia. Same thing with Swiss franc. Swiss franc usually rides on the coattails of whatever the euro is going to do. British pound, kind of off on its own tangent, but basically same sort of idea. He should be appreciating versus the US dollar during these cycles, and that's basically what's happening. The one that I'm actually very interested in, you'll see that this Japanese yen has been going down for quite some time, 77 weeks now. And actually, this time last year, that would be an excellent example of the weekly commodity trend survey. About a year and a half ago, we had a sell signal on the Japanese yen right at the top of the market. And it just, it's been going down now for 77 weeks. So that turned into a monster trade. But what I do see here is, look at this. I don't know whether you can see this chart. We're just basically on the cusp, it looks to me, of the Japanese yen breaking out. And if it does break out and it starts to move higher again, then what that tells me is that, number one, the Asian economies are starting to look a little better. Maybe the Chinese economy has stopped going down. The Japanese economy itself might be turning around. And we also might be getting a flight to quality in that it's perceived that the U.S. economy is actually in a bit of trouble, which means more Fed easing, more QE, and that's what actually drove this monster bull rally there a couple of years ago in the Japanese yen to begin with. So, interesting what's going on in the Japanese yen, because I would also argue, too, that, 50% roll is probably sitting somewhere up here in 115 area. I bet that we could go buy a 110 call option, and it's less than $2.50. If the market goes to 115 and we have the 110 call, then that means that we'll have 5 cents of intrinsic value. So if we could buy that option for less than $2.50, that would qualify as a weekly commodity trend survey options trade. So keep your eyes open for that. That might be coming down the pike fairly shortly. In fact, we can just go take a quick boo at the options premiums themselves. December 2014, which buys us a good 6 months of time. They're not even listing. Isn't that interesting? They're not even listing the 112. So, you can, did I put calls or puts here? I thought I put calls. Let's go back there. Yeah, I had calls. Isn't that interesting? So, even though the market's at, what is it at, like 98 or something, 98.26, they're not even listing anything above, oh, is that 115? Oh, I guess that's 115 there. So, 112, here we are. So, they're 130 points right now. So, that, in essence, is something that we need to pay attention to. We were looking at the 110s, weren't we? Oh, here, this is it. Look at this, baby. All right, so the option traded at, looks like 106 points. How do we read that? That can't be right. Maybe it is. Maybe that's 10.6. So last trade was 2 points. And somebody, that can't be a right quote. There's got to be something wrong with that. Look how much more that was paid than that. That's got to be a fat finger. This call option should be less than this price, not more. So obviously that's a mistake. But in essence, you see, previous settlement was 200 points. And we said that we expect the market to go 115. So that means the option should have 5 points at our 115 target. And right now, this last settlement price was 200 points. So in essence, the Japanese yen option prices are in our ballpark. So now all we need is a little bit of price action, and I would just say a close above this level right here. 98.73 is going to set up that trade. And basically the options are already set up for us. So there you go. If you got anything from today's show, you know that the cotton trade is already on. You could take a look at that if we get any pullbacks. But I would have a sharp eye on this Japanese yen because I think a trade is developing here. We get a breakout through there, and you know I'm going to be writing up one of these trade recommendations. So that's the currencies. It's now, what time is it? 6:30. Oh, that's not bad. Let's just quickly finish this off. Interest rates, you saw that I made a post on the U.S. long bond. You notice on the commodity trend survey, it just turned up. It started trending higher. First week of a trend, so very significant. Pay attention to the U.S. long bond. Stock indexes, we talked about how old these trends are. We also talked about the fact that the market that led the market, the Japanese market, has broken down, and now it's actually trending lower. So that's a big, there's, and the funny thing about the stock market is that, crashes will happen, and after the fact, people will say, well, why didn't you tell us? Why weren't there lots of warning signs? Why didn't somebody tell us? The simple fact of the matter is there are lots of warning signs right now. But is anybody paying attention? No. So next time somebody asks you, well, are there actually any warning signs that things are in trouble? The answer is an emphatic yes. There always are warning signs. All right, moving right along. In the metals market, somebody asked me whether I thought silver was a buy-in here. As you can see by the trend survey, we're still in downtrends in a lot of these markets. You can see the silver trend itself is getting very old at 72 weeks. So, I'm not prepared yet to actually get bullish there. The short trade has been stopped out, so it's not like we're short anymore, both on gold and silver. But you notice that copper just recently broke down. That's a professor of economics. So, that's not helping the situation. And then, of course, palladium, which is considered a rare earth metal. And because there's so many rare earth metals in Russia, it's getting a bid because of the whole Russian-Ukraine nonsense. So palladium's off on sort of its own ledge right now. But generally speaking, I think we're closer to the bottom. You notice lots of targets have been hit here on these. Stops have been hit. So basically, we're not too short. I will caution, though, that copper looks quite dangerous here. You can see, you hear me talk about M's and W's, big M, another M right here. So, we're breaking down. Here's a massive M. So, I wouldn't be too excited to get on the long side of copper just yet. And really, that's a function of industrial demand. And, we looked at some of the housing data in recent shows, and that's looking pretty weak, so not a big surprise. And, again, are there any warning signs? This copper is called the professor of economics. Why? Because whatever copper prices do is a very good proxy on the broader economy. Is this a bullish chart or a bearish chart? I'm sorry to say, but that's a bearish chart, not a bullish chart. All right, moving right along, energies. The energy market itself has been kind of trapped in a trading range for quite some time. Obviously, as a crude oil trader, I have to follow crude fairly closely. And you can see that crude has just been wedging out here for, this is basically the past 3 years. We've done nothing here in crude oil. which is a bit dangerous in itself because usually when markets go quiet like this, they're getting ready for some big move. Frankly, I don't know which direction it's going to be, but it will be big, I guarantee you that. In the softs market, what's really interesting is people were moaning and complaining about coffee, how it's gone shooting higher, and yet you can see a beautiful W right in here, and then another one in here. So there was lots and lots of warning that coffee prices were about to move higher in earnest, and sure enough, we've been long since January 31st. From 122.75. So that's like, if we look at the price chart, that's like right here. You see that? Right off of this breakout, nice W. And look at that trade. I mean, fuck, you could have retired off of that profit. There's the cotton. The grain markets, I don't really see a lot going on here. It's interesting that if you live in the southern United States, you have a choice basically to plant corn or to plant cotton. And so I find it very interesting how the corn and the cotton charts are trying to rally here. This huge gap really needs to be filled in. So my hunch is that just as cotton, I think, is going to be moving higher, I think corn wants to move higher. We might have a few week pullback here. That wouldn't totally surprise me. But generally speaking, 50% rules, Mr. Gann. I think we're looking at like 6.5 a bushel corn as we head through the summer growing season. But we'll see how that goes. A lot of the grains also play off of Russia. In the Ukraine, wheat is basically their #1 export. So you can see how the wheat market seems to be setting up bullishly here. This is a nice inverted head and shoulders. So it looks like we could rock and roll here. Problem with the trade, kind of like the bonds, the 50% rule is probably somewhere in here. So option premiums, I just don't think we're going to get a setup here that's going to make it worth our while to trade an option. But having said that, the structure here supports that cotton long trade. And then lastly, the meats. Very interesting what's going on in the meat market these days. You can see the massive W here on live cattle. The cattle market, this is actually what's known as a cup and handle formation. So the breakout through 135 was very, very bullish. And sure enough, it took off like a rocket. We had a bit of contract expiration issues here, which brought price down. I don't think that's realistic, especially when you look at feeder cattle, which did not have that expiry issue. Feeder cattle prices have just taken off like a rocket here. And really, this is, again, this is actually exactly what's supposed to happen during these markets. So really not a big surprise. Anybody who's watching, if you don't think politicians play the commodities markets, this is where Bill and Hillary Clinton made all their money. Back in the late 70s, they played the exact same bull market in feeder cattle. And I think the story goes they took $100,000 to $200,000 from the feeder cattle market. There's lots of people that are saying that they were given insider information, but the long and short of it here is knowing what part of the cycle we're in. It really, someone who makes money on the long side of the commodity market, really that doesn't surprise me at all. Okay, so that sort of summarizes the weekly commodity trends survey and what I see happening around the world and different ways to play the options market off of that. We'll do WDB options next week. We'll save that. Not quite sure what happened to all my cronies that said that we're going. What the hell does that mean? Switch to your screen for the stream. No idea what that means. Anyway, so I guess they lose. I'll pop over. I'm on the YouTube page now, so if anybody who's watching, if you have a question, feel free to post it. I'll give you a couple minutes to post. If I don't see anything, then I think what we'll probably do is just wind up a little bit early tonight. All right, so what I'm going to do, and I'm going to, let's see, what should we do? I'm going to load. I've been working on a theme song for my show, so I want to just load this, and I want to see whether it plays or not. So I have a song, a little disco beat here. And let's see, I hope you guys can hear this. And that's my theme song. So I'd love to hear feedback, whether you thought it was good or crappy. But I think I'm going to create an animation and have that song playing in the background for the beginning and ending of these shows. We'll see how it goes. It's a project I'm working on. Anyway, all right, so I'm just going to check in the YouTube channel. What do we got here? I hear something. What was that? Hey,
what's up, Brian?
Ascend decided to join. Hello, Ascend. How are you?
Hey, pretty good. Just finished dinner.
Oh, did ya? So I don't know what happened to Andre. He told me that he wanted to come into this show and for me to give him a tutorial on how to do the WDB, and I just don't know.
Yeah,
anyway.
He was pretty tired when we called, so I think he's taking a nap. Not
All right.
sure.
Well, no big deal. All right, so
You still live?
Yeah, so I'm just sort of winding things up here.
Did you see the Bitcoin?
What, is it taken off to the moon?
No, quite the opposite.
Oh no. Let's take a look. Well, I don't think one of these YouTube shows would be complete without at least a comment on Bitcoin. So let's see what we got here.
I'm a little bit worried.
Well, you know what? I was listening because I work with guys out of Chicago, right? And they have speakers on all the time. And one of the guy talking today was one of the guys talking about Bitcoin, and he said that he was told that the street consensus is that it should go down to $250. So, is it there now?
Not quite, and that is quite a lowering.
Quite what?
A lowering. I mean, 400 now, so 250 would be a brutal beat.
Well, I mean, I think, most of the street, remember we said the institutions don't buy up markets, right? They buy down markets. And I think that this is the level that they're keying off of. Can you see my chart? Yeah. So I think they're keying off of this old high. What's that high? $290. And then you see this low here, 265. So I think they're just looking at that area. Where are we now? So I put in some stink bids along the way here. So I wouldn't actually mind it coming down and filling me. That would be awesome. Okay, so we'll do the 4 hour. Ooh, juicy! All right, so hopefully everybody out in internet land and all of you regular readers should be sick of this chart by now. But the OTE sweet spot is 40107, and I've been just sitting here waiting for this level, driving me nuts. Momentum is still heading down. Willie, look at that. Remember, and actually this is a nice dovetail for those people that were watching through the whole show. Remember we talk about market structure, right? So if we ever get market structure where it's M-ish, right, that's bearish, And if it's W-ish, that's bullish. And what we got here is a nice M breakdown. So, and another M breakdown, another M breakdown, another M breakdown. So, I certainly don't have any reason to pound the table that this is bullish. And as I said before, actually this plays well because we're coming down into the OTE, and Willie is just now, he still isn't even stupid yet, right? We're still not stupid. We're at minus 81.69. He has to go below minus 80 to get stupid. So, what's really interesting is when Willie does get stupid, you often get these parabolic moves. So, the fact that we're in this area and it looks to me like price is starting to move down aggressively here, hopefully...
Hey, Brian, we can't see your screen.
Oh, you can't?
Yep.
Oh, that's...
And Bitcoin China just banned the deposits.
Well, isn't it? Yeah, well, I mean, that makes sense, right? And really, we want this damn catalyst to be out of the way, right? Get this damn event over with. Can you see my screen now?
Yep.
All right. So, this green box, I've been waiting and waiting and waiting for price to get into the green box. So that's basically, I've got order here for 0.25 coins. I've got $500 in ammo, so that's going to spend, I guess, about 200 of that 500, somewhere in that neighborhood. Is that right? Yeah, something like that. I'll look to buy some more, but I like this area in here. Anywhere below this 400, I think, looks sexy. And like I said, there are guys that are expecting 200 and change. Really, again, that really wouldn't surprise me. Sell in May and do something. Anyway.
Yeah, Brian, so I'm surprised, just making some personal trades here. I think it's going to go much lower, being that the news hasn't really soaked in yet. And I'll tell you, I'm surprised that you don't leave the opportunity open for a double bottom right here at the 350.
Let's see what you're looking at. Where was that?
Right on your screen, actually, extending that. So you have the OTE there, but I could see it coming down and hit a double bottom right there with lining up to this 350 right there.
You mean that low?
340. 340.
Yeah. Well, it wouldn't surprise me. I mean, basically the premise of the OTE, right, is that you want to set up a risk-reward trade where your reward is more than your risk. So my reward, and basically my assumption here is that we're in a trading range. So that's my potential reward from going long at 400. And this is my risk. So really what I'm saying if I'm buying at 400 is that I'm looking for a test of these highs, and I'm willing to risk this window here. So if I buy a half a coin and my average cost is $3.90 and I walk away at $339.99, then I'm risking what, $30? Does that make sense?
Yes, sir.
All right. I mean, I'm not putting all my capital to work. Absolutely not. And I am very comfortable with walking away from the trade if this bottom doesn't hold. Now, what it probably means is that you have to wait for the next OTE. Okay? And it might be another couple months. It might be another real painful process. You know, the problem here, right? I mean, you remember when the market was running up like this, right? This was right on the last China ban, right? This mess right here. What's interesting is that this happened ahead of the event, and then when the actual event happened, the market promptly started to rally. And I think that's sort of what I'm looking for. All right? All right, so I'm just going to take a quick boo at the YouTube page. What are these guys? Wow, these guys are all jumping up and down. All right. And they're swearing too. You know when they're swearing. So what's your? Let's see what your Hyperion. I love this guy's webpage, eh? Do you go to this guy? I think
Every
you were
day,
the one. You were the one who showed me it, wasn't it? Somebody anyway. Let's see what we got here. Lots of panic, blood in the streets. Oh,
Yep.
415. We're getting close to my target. I need it to go down more. More, go down more, go down more. Isn't that interesting? So, and you see the 416 level here, right? Let's see if we can put a Phoenix chart on this. Let's do it. Let's go over here. Whoops. I don't want to do that. Let's go. How do you do this? I think it's like this. Yeah. All right. Oh, so isn't that interesting? Look at why would BTCE be trading at such a discount to Stamp and Bitfinex? Do you understand that? Oh, did I lose a send?
No, I'm still here. Yeah, on the answer to that.
You understand?
Oh, I just got my trades going off like crazy in the background.
Look at that. Now
yeah, I'm not sure on that.
All right, so, I think I mentioned this before, right? The 61.8 is the top of the zone, right? And quite often, I know futures traders, I know one guy in particular, and the damn trade worked today, it pissed me off, is 61.8 tags, they're just buys. You just buy it. Don't even think about it, just buy it. So I wouldn't be surprised if we just tag this 419 and just get the hell out of there. Now, that doesn't necessarily mean that that's the start of a new bull run. We might only bounce like $10 or something, but I wouldn't be surprised if there's a bounce, some sort of play off this 419. And look at this now. The damn BTCE is rallying.
Yeah.
What the hell? Damn, I'm not going to get Bill. Oh man, never a dull moment. All right, so for everybody out in internet land and on the YouTube page, hope you've enjoyed the show. And I don't see any questions, so I guess I've either left you all speechless or I'm one darn good instructor. I don't know, one of the two. But I think we'll wrap it up there. And you all have a great night. And thank you, YouTube and Google Hangouts, for letting me provide this show tonight. Thank you, audience and people at TradingView, for popping in and asking to view the show. I would thank my co-host, but he seems to have disappeared right now. So Cry and the Chasm's show is only Cry tonight. I frankly am a bit surprised that I was able to fill 2 hours here, but here it is 7 o'clock. So you all have a great evening, have a great trading week. All the best to your families, and God bless. And we hope to see you all next week. Same bat time, same bat channel. I'm going to put on our exit music. Hopefully this will work. And once it's done, then we'll call it a night. So let's see if I can do this. So, have a great night, evening. All the best. We will see you next week.